Very good evening, everyone. Please confirm whether the audio and video is clear. Those who joined live, please confirm whether the audio and video is clear. Yep, thank you. So let us start with the session. I will be straight coming to the point. Number one, we are going to cover first the chapters like security analysis, portfolio theories. In portfolio theories, we are going to cover some important concepts from the exam's point of view. So before even going into the topic, I'm going to brush through all the concepts very fast such that what you cannot do individually, let us do jointly and complete this particular portion. So the target for the today's session is a confidence booster session, the live batch. The main objective is we need to complete the chapters like security analysis, security valuation, which includes share valuation and bond valuation concepts. Once these two are completed, we'll be doing the areas like mergers and acquisition. Okay. After mergers and acquisitions, the next area we are going to start with is mutual funds. So already recently I put on the currency swaps, all those things. I'm not going to touch all these now. First, I'm going to touch the concepts which are not covered in any of the revision sessions recently. Okay, such that it will be useful for you. And our target is to cover 50 marks in this particular session. Okay, so the main confidence of 50 marks you should get using this particular session. Let's begin. So are you all clear? Shall we start? Please respond. Can we begin? Yep. See here. See here, please, everyone. So to all who joined the live, thank you very much. Good evening, good evening, good evening, everyone. So Madhava, good evening. Gayatri, good evening. Dinesh, good evening. Devani, good evening. Saujanya, Y, good evening. So all of you, Dhansai, good evening, everyone. Let us begin. Okay. Security analysis. In security analysis, we are having totally three concepts. You can see on the screen. One is the exponential moving average. One is the exponential moving average. Second one is the efficient market hypothesis. Third one is the autocorrelation test or run test concept. Okay, first one, exponential moving average. Already one video I kept now. I'm not going to discuss any of those. Absolutely from the exam's point of view, let us move on. Okay, let's take this. See here. Whenever a question on exponential moving average comes in mind, whenever a question came in exam, always remember one thing. This is the formula. Okay, first, forecast for the T day means forecast for a day depends on the forecasted price of the previous day. This is called as a T minus 1. Okay, if you wanted to forecast the share price for day 7, you should not consider day 7 information, consider the day 6 information if there is a trading on that day. No trading, na, whatever the previous trading day is there, that day's price we have to take. Yeah, next. So ft minus 1 means forecasted price, not actual price. Don't do mistakes in exam. Forecasted price of the previous day, trading day, plus actual price prevailing a day before, trading day, and the minus the forecasted into alpha. Alpha is called as smoothening exponent. What it is? Smoothening exponent. Logics, everything, don't ask now. This is not the time. One video I made very clearly, and this is not the time to listen that video as well. From exam's point of view, question comes how to answer. That's all. See here. ft minus 1. ft minus 1 means forecasted price of the previous day, past period we call, actual price for the previous day, next minus forecasted price. Simply to tell, I expected this forecast for the previous day, I forecasted, actually this happened. My forecast is 100, my actual is 102, there is a 2 rupee difference or not, that we call as a error, that error will not be directly added, it will be multiplied with a alpha component and then added. Okay, that becomes the forecast for the current period. That's why see here, f means forecast, ft forecast for the current period, ft minus 1 forecast for the past period, at minus 1 actual for the past period. Okay, next at minus 1 minus ft minus 1 error in the last forecast. Okay, what is the formula for the smoothing exponent? How the alpha will be calculated? 2 by n plus 1, 2 by n plus 1. Let us start with the question now. See there, ICAI question. Closing values of NSE Nifty from 6th to 17th day of a month of January 2020 were as follows. There were days given 1, 2, 3, 4, 5 till 12th day they have given. Dates are given, day, Sensex. Important observation is not the days, not the date, not the day, not even the Sensex. Importance is the no trading days. No trading day. Okay. What does it mean? How to calculate? First, let us see the question. Calculate exponential moving average of the Sensex during the above period. The previous day exponential moving average of the Sensex can be assumed as 15,000. The value of the exponent for 31 days EMA is 0.062. 0.062. What is this 31? 31 is n. 2 by n plus 1 is the formula for alpha. Alpha equal to 2 by 32. 2 by 32. It will be equal to 0.0625 like that. 0.062 they have taken. Okay. This is the information given. What he is asking us to calculate? Calculate the exponential moving average. Exponential moving average. First observation. Question necessarily will come like this only in exam. They may change numbers, they may change the days, but concept doesn't change. Okay, it will be like this only. It's a standard way of asking these questions. Question comes in exam. How many days? 12 days is there. Day 6, 7, 8, 9 like that they have given. Thursday, Friday, Saturday. Saturday and Sunday sometimes the trading is not there. Then 6. Values are also given. He is asking us to calculate the exponential moving average. First formula. What is the formula? Forecast for the period equal to forecast for the past period plus error into alpha. Forecast for the previous period plus what is the error formula? A t minus 1 minus f t minus 1 into alpha. Let us do. How to do the answer? Let us see. No calculations, nothing. Fastly, let us come through the concept. Okay. First, we are in which date? Day 6. What is the Sensex? 14,522. These are all forecasts, actuals. These are all actuals happened. These are all actuals happened. See here. That's why in the question, previous day exponential moving average is assumed as 15,000. 15,000. First, 6/1/2020. Actual is 14,422. Actual is 14,422. Date 6/1/2020. Actual is 14,522. We want the forecast of 7. We want the forecast of 7. Forecast of 7 will be dependent on forecast of 6 less actual of 6 minus forecast of 6 into alpha. Okay, see there. Forecast of 6. He has clearly said forecast of 6 is assumed to be 15,000. Okay, question arises. Sir, he said previous day exponential moving average is 15,000. Where he said that it will be the forecast. Question will arise or not? Question will come in exam here, then you will get the doubts. Sir, what is this 15,000? Is this a forecast or actual? How to understand? It is a forecast because when I say exponential moving average, concept of exponential moving average comes out of forecasting. Okay. So therefore, point is, see here, F6, how much? 15,000. Forecast of the previous day. We forecasted 15,000. It happens to be 14,522. There is a error. Into 0.062, we got 14,970.364. Okay. So, what is the forecast? 15,000 is the forecast for the previous day. So, up to here, first point, everyone. Exponential moving average is 14,970.364. See here. First, 15,000 is the value of EMA on day 5. That means on day 5, 15,000 is taken as day 6 forecast. Okay, day 6 forecast. That's the forecast. We forecasted 15. Actually, this has happened. This day's EMA. Now tell me, 7, day 7, we are forecasting 14,970 to occur on day 7. But actually it became 14,925. So 7th day, okay, on 7th we will not forecast 7, we will forecast the next trading day. What is the next trading day given in the question? 8 no trading, 9 no trading, 10th only trading is there. So therefore F10 equal to F9 plus A9 minus F9 into alpha. F9 forecast for the previous period. How much is the forecast? 14,970 plus A9. Actually what happened? 14,924 minus 14,970.364 will give you 14,967. This will become the forecast of the next day. Forecast actual comparison again. Again you calculate. Like this, you have to calculate for all the trading days. So only remember one thing, formula. If you have the formula in hand, all the answers you will write correct. Tell me what is the formula? F T equal to F T minus 1 plus A T minus 1 plus minus F T minus 1 into alpha. If you have this formula with you, any question you will do right. Okay. One last time I am repeating, whenever question comes on a no trading day, previous day only will be taken as the forecasting day for the next. F10 we have to calculate. F9 really 9th day trading is not there. The previous forecast. Okay. 7th days only we will take as a 9. Okay. So see here, simple logic. Last day's forecast. Okay. Last day's forecast and the actual comparison will be the error. 14,522, 15,000 is the error. 14,925, 14,970 error. Like that we need to see the error calculations and do the answers. So have the formula in your hand and start doing the answers. You will get the answers properly, but see the schedule properly. Date, actual, calculation, EMA, forecast. These are all the various calculations to be done. Okay. Formula keep in mind properly and start doing it. You can do any kind of answer that comes in exam. Okay. First point number 1. Everyone answer to my question. Have you understood up to here clearly? We'll go into the next one. Or if you are okay up to here, we will go into the next part. We continue. Next. So once after this, the next concept we are going to start. See here. Efficient market hypothesis. Okay. Efficient market hypothesis. What is efficient market hypothesis? Let us understand. Efficient market hypothesis is a stepwise procedure. Okay. I'm not going into any of these details now. First, theoretically question can come in exam. First, listen carefully to my words. Okay. See here. See here. Let me first explain. What can come in exam? Efficient market hypothesis. In this chapter, the important concept is whenever markets are there, there are three types of markets, or there are two types of markets essentially: inefficient markets, efficient markets. Inefficient markets are those markets where prediction can be made on the prices, means how the next day price can be there. Prediction is possible by doing the technical analysis. Technical analysis means prices are moving up and down. One day up, one day down. One day up, one day down. One day up, one day down. If you understand, if you buy at a lower price, you sell at a higher price, you can make a bonanza profit. Again you buy at a lower price, again you sell at a higher price, again you make a bonanza profit. From this, what you have to understand, we know when to buy, we know when to sell by seeing the graph itself. Seeing the graph itself, that means using the graphical analysis of a particular chart, using the graphical analysis of the price movements of a particular share, if you can buy and sell and make profit, we call it as a inefficient market. We call it as a inefficient market. Logics I'm not going to tell now. Okay. So inefficient markets are those markets where predictability of the price is possible by doing a technical analysis. If a technical analysis can make a buy and can make a person to decide about to buy or sell or to get the bonanza profit, we call that situation as a inefficient markets. Second, what is a efficient market? Efficient markets are those markets where technical analysis may not hold good. Even you are very good at technical analysis, you can't make the profits. Okay, it is always a luck factor that will be involved. Market movements are not subjected to the graphs. Market movement is subjected to the investor's perception. Therefore, it is more efficient way. Okay, there are three types of efficient. Efficiency type 1, weak form of efficiency, semi strong form of efficiency, strong form of efficiency. Okay, what do you mean by a weak form of efficiency? Weak form of efficiency is such a market where it is efficient. Means what? Technical analysis will not help you. What will not help you? Technical analysis will not help you. Okay. Technical analysis will not help you to do anything. What you have to do? That's why. See here. I will show you directly. Okay. Directly see there. Instead of writing, I can directly show you. Technical analysis fails. Okay, you can't do. Profits can be made by making fundamental analysis only. Okay, that means try to understand the point. Weak form of efficiency is a market where a situation where technical analysis means by seeing the charts you can't make the profit. You have to know about the company, their ratios, how they are working, performance, everything you need to analyze. Their EPS, their DPS, their sales, their ratios, everything you need to analyze, and then only you can make the profit by buying and selling. That's called as a weak form. Semi strong means technical analysis will not give you profit. Fundamental analysis will not give you profit. The only way of making the profit is you should be an insider. Third one, semi-strong over. Strong form of efficiency. Technical analysis fail. Fundamental analysis fail. Insider trading also fails. Only option is buy, wait till it rises, sell and make the profit. Sell and make the profit. This is a real way in which the markets has to behave. That means person having a knowledge making gains, person not having a technical knowledge do not making a gain, insiders making a gain, outsiders can't make a gain. Like that it should not be. Everyone should be standing on a common platform. In pari passu with everyone, they have to make the gains and losses. Okay. So, efficient market hypothesis. Now we completed theoretical analysis of what are the two types of efficiency. Notes were shared in the Telegram group. You can get it. So, efficient market hypothesis. First thing, always remember this efficient market hypothesis concept carries on the concept of number of times the share prices are moving up and down. Okay, and symbols will be given as plus and minus. Okay, sir, I didn't understand. Fastly, let us complete this concept. I am putting only 8 minutes to 9 minutes to this concept. Listen. Notations in efficient market hypothesis. Exam la question came here. How to do? You will be given with information. All increases notated with plus will be N1. All notations with minus will be called as N2. How it will be? See here. Information will be given like this. 100, 110. There is a increase or decrease or increase. Plus. 100, 110 to 120. Increase or decrease or increase. Again plus. 120 to 90 minus. 90 to 80 minus. 80 to 65 minus. Okay. So how many times plus is there? 2 times. That is irrelevant for us. Now, as of now, how many plus are there? 1, 2, 3, 4. So 4 N1s are there. 1, 2, 3. 3 N2s are there. Runs. What do you mean by run? Whenever the market movement is changing, that's called as a run. Okay. One time increase, second time increase, next decrease. So one run completed. Run takes a reverse trend. So trend change is called as a run. Okay. So 3 runs. First, these 3 formula are the heart and soul of this particular area. Okay. First point number 1. Mu means an average. Mu means a average. Okay. Now, average has a formula. What formula? 2n1 n2 divided by n1 plus n2 plus 1. n1 plus n2 plus 1. How the formula? All these logics, this is not the time. First remember, what is the mu formula? Mu is represented by mean or average. Average equal to 2 n1 n2. n1 number of positive runs, n2 number of negative runs. Okay, divided by total runs plus 1 over. Next, standard deviation. Why standard deviation? Whenever I say average, average price can happen, cannot happen. There is a standard deviation for that. We are not using the portfolio standard deviation formula. A different formula is there. Root of 2n1 n2 into 2n1 n2 minus n1 minus n2 whole divided by n1 plus n2 whole square divided into n1 plus n2 minus 1. There is no option for you. You have to mug up the formula. Okay. At this time, this is not the time to learn about the derivations as well. So remember the formula. First one is a mu. 2n1 n2 divided by n1 plus n2 plus 1. Okay. Standard deviation. 2n1 n2 means first mean. Standard deviation के numerator is same. Later 2n1 n2 same minus n1 minus n2 minus n1 minus n2. Okay. Divided by n1 plus n2 whole square. Same. n1 plus n2 whole square into n1 plus n2 minus 1 into n1 plus n2 minus 1. This is the formula. Upper limit. Sir, what is this upper lower? Listen carefully. Point is, standard deviation means what? Average 8. Standard deviation 4. What does it mean? Average 8, but that average is guaranteed. No, it has a deviation of 4. Means 8 can go up by 12, 8 can go up to 12, or 8 can go to 4 as well. 4 standard deviation means positive can be there, negative also can be there. Therefore, average is 8. It can be added with 4 and become 12. It can be deducted by 4 and made 4 also. Anything can happen. Okay. See here. Upper limit and lower limit. Sir, mu means average. Standard deviation means I calculated there. Then what is this T? That's a TA important. For that we will see one question. Okay. Degree of freedom they call. Degree of freedom. N1 plus N2 minus 1. This is the formula for degree of freedom. What is a T? T is a T distribution value. They will give in the question. You need not do anything. T distribution table. Degree of freedom. N1 plus N2 minus 1. Let us take this question. Observations required. Let us do it very fast and complete. Question comes like this in exam here. So much big question. Very easy. Just to mug up the formula. Okay. First, they have given all this information. I have copied this information first. Date 1, 3, 4, 5. Like that they have given 1, 3, 4, 5. Same details I have copied here. Okay. Next. Closing index. They have given closing index prices. Okay. First. 2800 to 2780. There is a rise or fall minus. Next. And it became 2795. It became 2795. 2780 become 2795 means there is a addition. Positives will be there. Okay. This is run 1. This is run 2. This is run 3. This is run 4. This is run 5. this is run 6, this is run 7, this is run 8. That's why, that's why number of runs is 8. Next, how many positive symbols? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 minus 1, 2, 3, 4, 5, 6, 7, 8. 8. So tell me, how many times trend change? 8 times. A trend run. 1. Trend changed. 2. Trend changed. 3. Trend changed. 4. Trend changed. 5. Trend changed. 6. Trend changed. 7. Trend changed. 8. Number of runs is 8. Clarity? Yeah? Mu. What is the mu calculation? 2 n1 n2 divided by n1 plus n2 minus, plus 1. So 2 n1 11, n2 8, 11 plus 8 plus 1. How much? 10.26. What is 10.26? Average runs. Average runs is 10.26. Average runs is 10.26. Okay. Average runs is 10.26. Next, step 3. Standard deviation. Formula we applied got 2.06. Means this 10.26 is standard. No, this can move up, this can move down by 2.06 value. Okay. Degree of freedom. n1 plus n2 minus 1. 11 plus 8 minus 1. How much? 18. Question la they will give. See here. Value of t at 5% is this one, 18 degrees of freedom. 18 degrees of freedom na. Why 18 degrees? Here 18 came. Okay. This is 18. Even in the question if they give 11 degrees of freedom, ignore that information because n1 plus n2 minus 2 we got 18. 18 degrees of freedom in this question. Okay. Calculation of upper limit at 5% level of significance. 5% level of significance. Level of significance means what is the chance that it cannot occur. That's the level of significance. Lower limit. That means it can go lower to what? It can go higher to what? So mu minus alpha, mu minus sigma into t. Mu minus sigma into t. Because at 5%, what is the t? 2.101. 10.26 minus 4.33, 5.93. Upper limit. Mu plus sigma into t. So we positively we added 14.59. Means, tell me, lower limit can be 5.93, upper limit can be 14.59. 14.59. This is the upper limit and lower limit calculation at what significance? 5% level of significance. Like the 10% also you can calculate. Conclusion. Tell me, what is the actual? Actual runs is how much? 8. Okay, actual runs is 8. Okay. At 10% level of significance, what is the lower? 6.69. What is the higher? 13.83. What is the actual runs? 8. If the actual runs what you got in the answer, if it is between lower limit and upper limit, between lower limit and upper limit, if it is somewhere in the middle of both of them, we call it as a efficient market and weak form of efficiency. Efficient market and weak form of efficiency. So summarize the entire question now. Question will be given. First to put the positive negative symbols. For that 2 marks will be given. Later steps. Step 1. First basic information. Number of runs positive negative. Later mu calculation. 2 n1 n2 divided by n1 plus n2 plus 1. Standard deviation. For this all these will get 1 mark. Degrees of freedom 18. Question like 18 degrees ki what is the information? See. We have to calculate the lower boundary and upper boundary such that we will know whether our number of runs is between that or not. Lower means mu minus sigma into t, higher means mu plus sigma into t. We got this answer. What is t? T value for 5% level of significance. They will give in the question. Okay. Okay. Next. For 10% I give the final answer. So we got actual number of runs as 8. Lower is 6.69. Higher is 13.83. Since the number of runs is in between upper limit and lower limit, market is efficient. It is a weak form of efficiency. Here everyone? Everyone please answer. Are you all comfortable up to here? Understood? Just for your reference, I am putting it before you. Take a minute time, complete it fast. Just for a minute, I am putting it for your display. Clear? So one question was asked, if no number of runs in between upper and lower, what will be the effect? For example, if you got the answer in exam, your number of runs came to, say for example, 5, or your number of runs 5, or your number of runs comes to 16, say for example, we will tell that market is inefficient. Market is inefficient. So market will be efficient only if number of runs are between the averages. Two averages. One is upper average, one is lower average. It should be in between both of them. Some number between them. Then we call it as a efficient market. But it is called as a weak form of efficiency only. Next. Next one. So once we completed this, the last one. On this, I didn't even give a problem. I will just tell you how to do. Because correlation concept is there already in portfolio. There we will learn anyway. Okay. First, what is this autocorrelation test? Autocorrelation test or serial correlation test. What is this particular idea? Let me explain. See here. Markets can be predicted in two ways. Using the charts, you can predict. Using efficient market hypothesis, you can predict. There is another way called as a autocorrelation test. Autocorrelation test. What does it mean? See here. I will be given in the question information of 30 days. Listen to my words properly. Okay. I will be given information of 30 days or 10 days or 5. Some number will be given here. Some data will be given in the exam question. Listen or else you can't crack these questions so easily. Listen again. There will be information given to you regarding a particular period. Okay. Totally 10 days information they will give. They will ask you to calculate autocorrelation calculation. How to do? Break that into half. Means what? They will give information such that half breaking is possible, or they will give in the question directly. 10 days information given. Break it into 5 trading days. 10 trading days information will be given. 5 break it. Done. Then what we need to do? We need to see how first 5 days are having influence on the next 5 days. Is there any correlation existed between first 5 days and next 5 days? That means, is the markets of the company are trended on the basis of the past or not is a question now. How to understand? See, step 1, identify the prices of the stocks over different time lags. Time lag is a concept where we will break the total data into 2 or more parts and find the correlation. Next, step 2, calculate the price changes. Calculate the price change. They will give 100, 120. Day 1, 100. Day 2, 120. We don't want 100, 120. We want the change. How much change has come? 20. Like that we need to take. Clear? Next, calculate other statistical outputs. Means we need to calculate the mean sigma x by n, standard deviation, root of sigma x minus x bar the whole square divided by n, covariance sigma x into x minus x bar into y minus y bar divided by n, correlation rxy equal to covariance of xy divided by sigma x into sigma y. All these calculations we have to do. Interpreting the correlation. rxy x time lag minus 1 y time lag 2. Sir, what is it? All these calculations we will see here. See the screen. First, step 1, hope you understood the concept. Step 2, calculation of price change. Step 3, other statistical outputs. Step 4, interpreting the correlation. What do you mean by that? See here. See the screen. Important. Situation 1, you got the correlation as 0. Markets are efficient. Means what? On the basis of trend, you can't analyze the market. Correlation is 0. No correlation. That means using technical analysis, you can't do anything. Fundamental analysis only will help you. Therefore, efficient. Nearing 0, efficient. Plus 1, inefficient. Minus 1, inefficient. Nearing 1, inefficient. If the correlation is 0 or nearing 0, it means price change of 2 different time frames do not exhibit any relation. They are randomly walking. That's why in the study material you will see a concept called as random walk theory. Markets are efficient if the randomly prices are walking up and down. Okay, this is all the analysis. What we have to do? Tell me. there will be information of a group will be given 1 to 10 days. Okay, 1 to 10 days. They will give some information. Wait for a minute. I will show you one question also. You will also get a clarity. Before showing that question, read all the 4 steps properly. Just a minute. I will be coming up with a problem. I will share you the document. See here. As I promised, I will show you a question answer. Okay. See here now. Sir, first thing, are you all with me? Everyone listening? Okay. Let us continue. See here. Like this information will be given. Mr. X is of opinion that market has recently shown weak form of efficiency. In order to test the validity of his impression, he has collected the following data relating to the movement of Sensex for the last 20 days. Last 20 days. Opening, high, low, close. Like this they have given. High, low, opening and closing. Information given. How many days? 20 days. You are required to test weak form of market efficiency using autocorrelation test. Time lag 10 days. Means divide the total information into 2 parts, 10 days and 10 days. Check whether there is any correlation between first part and second part. Means if first 10 days there is a downward movement, next 10 days again downward, or first 10 days down, next 10 days up, or next 10 days up, next 10 days up, next 10 days up, next 10 days down. Means what? First period la rise, next period la rise. First period la fall, next period la fall. There should be a trend na. Either negative trend or positive trend. If it shows, by technical analysis you can make a profit. Means what? A person is there, he saw the trend. Array, month la first 10 trading days rise is there na, next 10 days there will be a fall. Means what he will do? Second part of the month they will buy, first part of the month they will sell, they will get an obvious gain. By seeing the charting itself they are making a profit. Then markets are not efficient. Are you understanding? If the correlation is not there, then markets are efficient. How to do? See here. Shall we do? Okay. Sir, I am not going to do any calculations now and waste your time. Just I am going to show you. Sir, higher, lower rates are given or not? Higher, lower prices. Okay. Those are irrelevant. For us, what is relevant? Opening, closing. Most important thing is opening and closing. Okay. Mostly for us, the opening and closing, closing we will take previous day opening will become, previous day closing will become the next day's opening. Am I clear? So see here, day 1 closing, day 2's opening. So high low is irrelevant for us. Opening and closing are relevant for us. Irrelevant is high low, relevant is opening and closing. Okay. Closing price. First day. You take first day. This is the closing price. This is the next day's, okay, closing price. First day closing, second day closing. There is a change. There is a change. So you have taken the difference between both of them, divided by 33,453, you got 0.057273. Okay. Like this, you calculated all the percentages. This is X. This is X. This will get a mean. This is the mean you got. Okay. Mean you got. This, you got this one. Okay. Mean you calculated the returns X bar. X bar means the means you calculated, X minus X bar you calculated here. After that, X minus X bar the whole square. All these you have square. Same, sir. Take all the information. Take the difference. Difference divided by closing price. If you take, you will get one value. Like that, calculate for all the days. X bar will come. X minus X bar you have to write here. Okay. After that, square it. You will get these values. Okay. Finally, you will get a variance. Standard deviation you will calculate. Same formulas you have to use. Okay. Next. Closing prices of period 2. Like this, you take 33,285.89 minus 33,251.53. You will get one value or not? Okay. Divided by 33,285.89. If you do, you will get this return. Calculate like this for all the days. Later, this is a Y. Later, this is a total. Divided by 10 means this is an average. Y bar. Y minus Y bar, you will get this value. Like that, Y minus Y bar you have to calculate. Square them. Y minus Y bar the whole square, if you total them, you will get this. Divided by 10 means you will get this average. Standard deviation, you will get this answer. Over. We calculated mean, standard deviations. All are calculated. Correct? Next. Covariance between returns. Covariance means what? X minus X bar. Return means X. X minus X bar. Y minus Y bar. X minus X bar into Y minus Y bar. You calculated covariance. You got this. Using the covariance, you will calculate the correlation. You got 0.405. What do you mean 0.405? 0.405, okay, means it is not nearing 0. It is not even 0. If it is 0 or if it is nearing 0, then only markets are said to be efficient. Here it is not 0, not even nearing 0. Therefore, does not show the weak form of efficiency. Clear or not, everyone? Okay. Now question. Sir, this is a big process, sir. Exam they will give for 6 marks or exam they will give for 8 marks. Then I have to do all these calculations, sir. It takes lot of time, sir. Then alternative solution is also there. This is the most easiest way. Sir, you would have told this first, na, sir. We don't know, sir, in what way student will do. If I show both of them, na, you will get a clarity. See here. First 10 periods closing prices. Directly take the change. Okay. 33,453.99. This difference. Like that, take the differences. Over. Now, you directly take the changes now. X is all the changes. X bar. Y. X square, Y square, XY. Directly using normal calculation is there. Like this you can do and you will get the R as 0.405. 0.405. So, there is a degree of correlation between and does not show the weak form of efficiency. Sir, you can do like this. Again, you can do X minus X bar, Y minus Y bar also here. Either you can do in the first model or you can do in the second model. Any way you do, just the formulas will change. I am displaying this before you. If you want, just take a snap. After the class, just practice for 5 minutes. Don't leave these questions. Exam they will become important. Recent attempt na Jan 21 8 marks question has come. Okay. And moreover, if you observe, all calculations to be done in 6 decimals. That's why here I have given the answer for 1, 2, 3, 4, 5, 6 decimals we have done. First, everyone, please tell me, have you all understood up to here clearly? Everyone on the live, understood? Sir, if you give a response, I will also get a motivation to move to the further into the next topics. Completed? So the next one. So we have completed security analysis chapter. Which chapter? Security analysis is completed. Just you need to remember the formula and try to solve the answer. Okay. First model you try in exam because it may take 5 minutes extra, but it is a known process of portfolio theories. So you can do it very easily and complete it. Okay. Next. After that, we are going into the next area. First we have completed which one? Security analysis. See here. Security analysis over. I am coming into the concept of security valuation. Security valuation. See here. In security valuation, what are all the important concepts you need to look into? So this is not a time to solve all the problems by sitting. First, listen carefully. What are all the questions he can ask in exam? First one, he can ask a question on a garden model. Which one? Garden model. Whenever question comes in the garden model, formula P naught equal to D1 by K minus G. D1 by K minus G. D1 will be D0 into 1 plus G. KE means cost of capital or cost of equity, also called as capitalization rate. Okay, return on equity, cost of equity are not same. Return on equity is R, cost of equity is KE. Why R will be given? G equal to B into R. For that R will be given. So be careful. Okay, next. D1 means what? Expected dividend. D1. Dividend to be paid. D1. Dividend proposed. D1. Dividend just paid. D0. Dividend paid in the last year. D0. All these languages are important. Okay. Garden model. Next one. Second one. They may ask you a question. Okay. Chances are very less, but chance is there. Walter model also they can ask. P equal to D plus R by KE into E minus D whole divided by KE. Steady meter only one formula was given, but problems are not there. But don't take the risk. This also can be asked. D means the dividend. R means return on equity. KE means cost of equity. E EPS. D DPS divided by KE. You will get the formula for P. Okay. You will get the value of P. This is another way of asking. Next one. Another important question from this chapter. Security valuation. See here. First question. It is dependent on which model? Gardens model. All these are study material questions. Okay. First question is on the Gardens model. Gardens model means what? It will be more based on D1 by KE minus G, or P naught can be also written as, instead of writing it as a D1, I will write it as E1 into 1 minus B whole divided by KE minus BR. E1, earnings of the next year, EPS. Okay, EPS. Next, 1 minus B. B means retention proportion. B means retention proportion. What is the B1? That's what is the B? 0.4. Next, 1 minus 0.4 E. Here if you observe, EPS 3 was given. How much given? EPS is 3. IRR means R. Cost of capital, KE. KE minus B into R. See here. E, you forget about it. First point. D they have given. How much is the D? 3. Retention is 40. Means how much is the payout? 60. If 60% is equal to 3, how much will, if 40% retention means how much is payout? 60. 60% is equal to 3 means 40% is equal to how much? Okay, the balance 2 rupees. So totally how much is the E? 5 into 1 minus 0.4 divided by KE. How much is the KE? How much is the KE? 0.18 minus B into R. What is the B? Retention proportion. 0.4 into R. 0.22. We'll get the answer. That's how we have to do. Next. Book value 137.8. Return on equity 15%. First question in your study material. If you open 137.8. Return on equity 15%. It retains 60% of its earnings. Cost of capital 18%. Price of the share using Gordon's model. Listen always. Question la book value per share is given. Return on equity is given. Always blindly follow one formula. Okay? See here. EPS equal to BVPS into ROE. EPS equal to BVPS into ROE. Formula, you remember. In the original class, I said you the interpretation, logic, derivation of the formulas also. This is not the time. So simply, EPS will be written as BVPS into ROE. BVPS into ROE. Next. Some important questions I will tell you. See here. So Gordon model he can ask. Walter model he can ask. EPS calculation will be BVPS into ROE. BVPS into ROE. This is the next formula they can ask. Very, very important concept is rights shares they can ask a question. One, rights shares. Rather than doing it, I will show you directly. Please listen carefully. Important, sir. This attempt chance is also there. It can come in exam. See here. Okay. See here. How they will ask a question. Rights shares they will ask three important questions here. Question number 1, type number 1. What is the first type? They will give you the details regarding the right shares. They will give you the details regarding the right shares. Means this information they will give. Number of shares, current market price per share, rights ratio. So number of shares now 75,000, current MPS 24, rights ratio 1:4. They will give this. Next, he will ask you to calculate the theoretical post rights price per share. Theoretical post rights price per share. How to calculate theoretical post rights price per share? Mn plus SR divided by N plus R. What is M? Market price per share before rights issue. Market price per share before rights issue. N. Number of shares before rights issue. S. Subscription price. R. Number of right shares. Mn. Wealth prior to issue. SR is the additional wealth. See here again. What is the formula? Theoretical post rights price. Formula. Mn plus SR divided by N plus R. M. MPS before rights. N. Number of shares before rights. S. Subscription price. R. Number of right shares. Both put together. Mn. Wealth prior rights. SR. Additional wealth. Mn plus SR. Total wealth. N plus R. Total shares. Okay. So already information is there. See here. Number of shares prior to the rights. How much? 75,000. 75,000. M. 24. So SR. This is a value total. You got 22.4. What is 22.4? Theoretical post rights price. What is the formula? Mn plus SR divided by N plus R. M. Price before rights. S. Subscription price. N. Number of shares before rights. R. Number of right shares. N plus R. Existing shares plus additional right shares. Totally the shares are N plus R. Next. Very, 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 very important. Theoretical price of the rights alone. What is it? Theoretical price of the rights alone. How this particular point will apply? Theoretical price of the rights alone. See here. Post rights price per share 22.4 we got. Subscription price given means at what price we are subscribing to the right share. See here, they have given in the question already 16. So post rights price you calculate at step 1. So step 1 value minus subscription price, this is called as the theoretical cost of the rights alone. Theoretical cost of the rights alone. That's all. These are the two important formula. Number 1, mn plus sr divided by n plus r. Okay, next one, post rights price per share or theoretical post rights price per share 22.4, subscription price 16. That will become what? Cost of the rights alone. That's all. Regarding the right shares, this is an important observation that one should make. Okay. In this chapter, next very important area is two-stage dividend model. Which model? Two-stage dividend model. Listen, I will tell you how to do the answer. Simple. They will give you some number of years. They will give you dividend cash flows of the years. Okay. See here. Year 1, 2, 3, 4, 5. Cash flow. What they will do is first 4 years or first 5 years. First 5 years. There will be a growth of 10%. They will tell. There will be a growth of 10%. They will tell. First 5 years growth is 10%. From 5th year onwards means what? From the 6th beginning onwards till perpetuity. From the 5th ending onwards till perpetuity, it will be going to have a growth of 4%. They will tell. How to do? First 5 years 10% means what? Cash flow expected is 10 rupee. 10 rupee plus 10%, 11. 11 plus 10, 12.1. Like that we will add. Clear? We will get one value. From 5th onwards, it will grow till perpetuity, he will tell. Means from the 5th ending onwards. What is the real meaning of this question? There will be a shareholder. He wanted to hold the share for 5 years. He will sell at the end of 5th year. I wanted to sell at the end of 5th year means I want P1, P2, P3, P4, P5, P5. P5 will be dependent on D6 divided by K minus G. D6 can be written as D5 into 1 plus G divided by K minus G. D5 you will get one answer, some X, plus growth for the perpetual period 4% or 0.04 divided by K will be given. Let's say some 12% is there. Minus growth is how much? 4%. That value you have to write here. Okay. Both of these will have a common PV factor. PV at the rate of say 10% is there. You will write all the percentages and you will calculate this is the present value of the share, also called as a fair value of the share. Okay. How two-stage dividend model should be done? So what is the meaning of two-stage dividend model? It is a concept where an investor hold the share for some number of years. After that he wanted to sell. Whatever he hold is the holding period. Whatever he sell is the selling period. 1, 2, 3 he will hold. Okay. Third year ending I wanted to sell means I will sell at the end of first year, second year, third year. Third year I will sell. Okay. Means I will get the dividend for first year, second year, third year. After receiving dividend for third year I will sell. That's why the selling price is always ex dividend selling price. What selling price? Ex dividend selling price. First confirm whether everyone understood all these concepts clearly. Everyone understood the concept up to here clearly? Please do reply. We move on. Okay. So, security valuation chapter, these are all the important issues here. Next. After that. Next. Portfolio chapter. The portfolio chapter, I will give you the overview. Okay. Listen carefully. This is one chapter where you can expect at least 15 marks in exam. Okay. Let us see what is the most important concept in portfolio chapter. Whenever question is asked on return calculation, return can be of two types: simple average return, weighted average return. Simple average return formula will be return of security X equal to sigma X by N. Weighted average will be X equal to sigma P into X. Probability या proportion probability into X. Number 2, risk. Whenever individual security risk has to be calculated, sigma X equal to root of sigma X minus X bar the whole square divided by N. Sigma Y equal to, or if it is a weighted average, this is simple average. Sigma X equal to root of sigma P into X minus X bar the whole square. Okay, how to do? Let us see one question and try to understand. Each and every concept I will show one question and I will move on. See here. Like this, they will give info. X minus X bar, X minus X bar the whole square. X total is the mean. X total is the mean. Mean you calculated. 6.6 minus 5.96, this one. Like this, we have to calculate. Lastly, we have to take the X minus X bar whole square. Total. Sigma X minus X bar whole square divided by N. This is simple average. Why simple average? Probabilities are not there. Like this we need to do. Next, one question on probability. Let us see. Good, average, bad, poor. 4 situations. Probability. Okay, return 20, 16, 10, 3. 20 into 0.12, 16 into 0.4, 6.4, 10 into 0.33, 3 into 0.2, 0.6. This is a total PX. PX means what? Total return. 20 minus 12, 8. 16 minus 12, 4. 10 minus 12, minus 2. 3 minus 12, minus 9. X minus X bar the whole square. So sigma P into X minus X bar the whole square. This is a variance. Root, if you calculate, you will get the standard deviation calculation. Done. Next after that. Next. See here. Risk return profile of the portfolio of securities. One security calculation we have done. Now we need to see if there is a portfolio of securities, how to solve. What is that? Portfolio of securities. Return. WX, RX, WY, RY. Return. Means what? Return of two securities is just the weighted average return. What is the weight of the security into return of the security? Two securities na add. That's all. Return calculation is done. But risk of two securities is not like that. Root of Wx square sigma x square plus Wy square plus sigma y square plus 2 into Wx Wy sigma x sigma y into Rxy. This is nothing but a plus b whole square formula with additional Rxy at the end. Logics, everything I already discussed in the main topics of portfolio. Today, this is not the time to know about the logics. No overaction involved. Just examination point of view. Let's revise everything. Root of Wx square, weight of security x square, sigma x, individual security of individual risk of security x square, Wy square, weight of security y in the portfolio, individual risk of security y the whole square, 2 Wx Wy sigma x sigma y, correlation of x and y. They will give in the question. We have to do that. Next, correlation can be 5 types: -1 perfect negative, -1 to 0 negative, 0 no correlation, positive 1 plus 0 2 plus 1, plus 1 is perfect positive. Next, question will be asked. Sometimes they will ask, in what proportion we have to invest to reduce the risk to 0. If R equal to -1, repeat, if R equal to -1, by injecting Two securities in a particular weights may even reduce the risk to zero level. What is the formula? Px means weight of x, proportion of x in the total portfolio should be sigma y by sigma x plus sigma y. Don't ask the logics. Already derivation also I have given in the regular class. This is not the time. Just remember when this formula will be used. When he ask a question in the exam saying that in what proportions we have to invest x and y to make the risk to zero level when r is minus 1. This formula. No sir, he asked r equal to 0.45. Then he asked the question, risk should be reduced. Zero level we cannot reduce, but we can reduce. Using what formula? Covariance of y. Proportion of x should be covariance of y. Listening everyone? Covariance of y. So instead of taking this, or I will write this way, you can understand like, sorry, variance. Variance of y minus covariance of xy whole divided by variance of x plus variance of y minus 2 covariance xy. What is this formula? This formula will be used to reduce the risk to the maximum level. That means minimum ki you can bring the risk. I'm not telling zero level of risk. Zero will be possible only if r is minus 1. If r is minus 1, by injecting the securities in a particular proportion, you can reduce the risk to zero level. When r is other than minus 1 and other than plus 1, you can reduce but not to zero. Minimum extent we can reduce. Means maximum reduction is possible such that minimum risk will come. What is that? Variance of y means sigma y square minus covariance of xy divided by variance of x plus variance of y minus 2 covariance xy. That is the formula. Using that we have to do. Next, let us see one question where we have to calculate the mean, standard deviation, covariance, correlation with the proportions. See here. Information is given. See the screen. Written 10, 14, 21. A. Probability given. A into P. This is the calculation. So we got the mean. We got the standard deviation. A minus A bar. A minus A bar means 10 minus 14.9 minus 4.9 like that. A minus A bar the whole square. P into A minus A bar the whole square. What is this? Sigma P into A minus A bar the whole square. We want to root such that we will get the sigma A. So sigma A equal to root of sigma P into A minus A bar the whole square. So totally how much we got? 4.323. What is 4.323? Sigma A. Like that we calculated also for sigma B. P into A minus A bar into B minus B bar. Okay. Covariance ki two formulas are there. Which one? Covariance. Covariance simple average is sigma x minus x bar into y minus y bar by n. Okay. Weighted average sigma P into x minus x bar into y minus y bar. N will not come because probability is already total into 1. So A minus A bar into B minus B bar. We calculated. This is a covariance. P into A minus A bar into B minus B bar. Total will become the covariance. Correlation. Covariance of AB divided by sigma A into sigma B. Totally we got 0.455. 0.455. This is how the calculation. So tell me, what is the formula for the covariance? Covariance equal to sigma x minus x bar into y minus y bar by n. Simple average. Weighted average na sigma P into x minus x bar into y minus y bar. Sorry, that's all. Y minus y bar. Always remember, x is actual return. X bar is mean. Actual minus mean variance or deviation you can call. Okay. So whenever information is given, you have to take like this with the probability. Situation 1, 2, 3. A. They have given 5, 6, 7. Don't total them. If probability is given, probability to multiply and take the total. Probability 0.5, 0.3, 0.2. Multiply them. You will get the A into P. Means probable price will come. So this is called as a A bar. A minus A bar you have to write here. 3 information. A minus A bar whole square information. P into A minus A bar the whole square. This probability into this column will come. You total this. This will become sigma p into a minus a bar the whole square. Totally, this will become the standard deviation of a. Like that for b. After that, a minus a bar, okay, b minus b bar. Like this for other security also will come. Total into probability, if you multiply, you will get the covariance. Correlation calculation will be covariance divided by sigma a into sigma b. You will get the correlation also. Okay. Everyone in the class respond, understood up to here clearly or not? Okay, done. Next one. So up to here, please see the concept once. See here. The formula ne important in this particular area. Please see the formula properly. Okay. All this I'm not going to discuss. The main concepts we are going. Next. The most important area. Okay. The most important area after this is the concept of CAPM. Concept of CAPM. Very important concept that they always ask in examination is APM. See here. CAPM. KE equal to RF plus beta into RM minus RF. This is a formula. KE equal to RF plus beta into RM minus RF. This is a formula. Okay. One security na directly you can do KE equal to RF plus beta into RM minus RF. If multiple securities are given in the question, we should not take beta, we should take the beta of the portfolio. What is the beta of the portfolio? Weighted average beta means what? W x into beta x of a security plus WY into beta y. Two security, three security na WZ, beta Z, four securities na WA into beta A. Like that, just it is a weighted average beta. Beta represents what? Weighted average beta. RM, market return. RF, risk free return. So totally we will calculate the KE under CAPM. So CAPM KE is nothing but KE equal to RF plus beta into RM minus RF. Just we need to apply this formula, you will get the answer. But there is one concept in portfolio theories chapter which is called as underpricing and overpricing. This very important for exam. I will show you how the questions will come and we should answer. See here. KE equal to RF plus beta into RM minus RF. Beta into RM minus RF. This is the KE calculation. This is the KE calculation. Once a KE is calculated, RF plus beta into RM minus RF, you will apply the formula. You will get a KE. Let us say you got the KE as 12%. What is the price of the share? D1 by KE minus G. In this KE, put this 12%. We will get some P naught. Let's say you got 48. In the question they will tell. What they will tell in the question? The actual price in the market is 36 they will tell. Okay. Now tell me, how much is the KE? KE is called as a required return. KE is called as required return. Okay. How much is the KE? 12%. Using the 12%, you calculate the P naught. Okay. Ideally, it should be how much? 48. But in the question, they have given how much? 36. Means market is not expecting 12. Means what you require to give is 12. But market is not expecting 12. Market is expecting differently. That's why price is not 48. Price is 36. When price will be 48? If really market is also expecting 12, then price will be 48 even in this case. Are you understanding or not? That means you will be getting one KE. Put that KE in this, put the 12 in this KE. You will calculate the P naught. That P naught is 48. Market also is 48. What does it mean? Market is expecting what you are required to give. Okay. But here what happened? What happened here? KE 12, at that stage, P naught should be 48 fair value, but actual value is how much? 36. Means share which should have been traded at 48 is now traded only at 36 in the market. Pricing underpriced or overpriced? It is underpriced. When something is underpriced, what we have to do? Buy the stock. Okay. Second example. KE you got 12. Okay, KE you got 12. Price you got 48. In the market, it is not 36, it is 56. Means it should be at 48, but it is trading at 56. The share is overpriced in the market. You have to sell. 48, 48 you got. In this case, correctly priced. Don't buy, don't sell. If you have, hold them. This is how we need to do the questions. Always equilibrium price means this price is equilibrium. This is the actual price. Comparison between both of them, underpricing and overpricing, you will tell. This is one way of doing it. Or second way is also there. He may also ask you on KE comparison. What comparison? KE comparison. Let me explain what does it mean. You will calculate KE equal to RF plus beta into RM minus RF. Say example, you got 14%. How much? 14. They will give you D1. They will give you P naught. They will give you growth. You will calculate KE under D1 by P naught plus G. Under this mode also you will calculate KE. You will get one answer. Say you got 16%. This 16% is calculated on the basis of beta RM minus RF on the basis of price. On the basis of price. If this is also 14, really as per KA market is trading, equilibrium price is there. You got 16. Okay, see here. This KE is market expectation. This KE is required return. So see here, like this we need to do the question now. Situation 1, 2. RR, ER. Okay, RR, ER. So RR, ER, what is the situation going on? This is serial number, situation, valuation, decision. RR, we are expecting 14. We are required to give 14. Market is expecting 16 if I take the price. We are required to give 14. Market is expecting 16. Simply to tell, market when it expects 16, we are giving only 14. Situation, ER greater than RR. ER greater than, we are expecting 16, but you are giving only 14 to us. What does it mean? You are not giving what we are expecting. We will undervalue the stock. Decision is to buy. Like this also questions can come. Okay. This is on the basis of undervaluation and overvaluation of these stocks. Okay. So first up to here, everyone understood the concept clearly? Understood this area clearly, everyone? Undervaluation, overvaluation concept. Okay. Questions can be of two types. Price comparison, KE comparison. Price comparison means what? You will first calculate KE, put that KE in the D1 by P naught plus G, D1 by KE minus G equal to P naught. Compare the P naughts. Sometimes they will give the price of the shares. They will only give you the KE. You have to, they will give you KE. You will calculate the CAPM KE. They will only give you the price. They will only give you the price. Growth, everything they will give. Just you need to calculate KE using D1 by P naught plus G. That KE, CAPM KE, you will make a fair comparison. Okay. Then also you have to take a decision. So KE comparison question has to be done, or price comparison you have to do. Different types of questions can be tested in exam. Okay. I will summarize everything. Listen carefully. First you will calculate KE using RF plus beta into RM minus RF. We call it as a CAPM KE. Put this KE in D1 by KE minus G equal to P naught. Price will come to, say example 50. Okay. Market la compare. It is 50. You should You calculated P naught using the CAPM KE, that is equilibrium KE, you got 50. Market also 50 is there, means markets are correctly priced as per CAPM. Market it is 60. It should be 50, but it is 60 means KE is not as per CAPM market is expecting. Market is expecting something other than CAPM KE. So what is that? There is a overpricing. Overpricing a sell to get a gain. Next, you got 40. Underpricing a buy. This is one way. Or second way, how they will ask a question. See here. You will calculate CAPM KE. RF plus beta into RM minus RF. It is common. You will calculate this. Once after calculating this KE, you will get a CAPM KE. Now what you will do in the next step? Taking the CAPM KE, you will now calculate KE equal to D1 by P naught plus G. In the question they will give you D0. Add the growth and calculate D0, D1. Growth will be there. Price also they will give in the question. You will calculate a KE. This KE and this KE is equilibrium. This KE is not same. What happens? This KE as per CAPM called as RR. This KE is market expected ER. Okay. I will write this way. ER, RR, ER greater than RR or less than RR we have to write. If ER is greater than RR, we are expecting something but you are giving lesser. ER is greater than. Okay, undervaluation buy. ER is less than RR, overvaluation sell. ER is equal to RR, correctly valuation or equilibrium, hold the share. Next. Next topic is, in the portfolio theories, the most important next topic will be the concept of levered and unlevered beta. What is the concept? Levered and unlevered beta. Directly I will go into the formula. See here. Levered and unlevered beta. First, what is levered beta? Levered beta means beta of a company where debt is also there. Unlevered beta means beta of a company where debt is not there. Debt is there, levered. Debt not there, unlevered. Debt is there, levered. Debt is not there, unlevered. Without taxes, with taxes. Without taxes, with taxes. Without taxes, this is the formula. With the tax, D into 1 minus T. Okay, D into 1 minus T. Sir, what is D? Question will arise or not? Proportion of debt. Proportion of debt. For example, 60% debt, 40% equity. Okay, 0.6 into 1 minus T, like that. This is the proportion. This is not the value of debt. Proportion. E means proportion of equity. Okay, so simple formula. Tell me, what is the levered beta formula? Beta levered equal to beta unlevered into D into 1 minus T plus E divided by E. That's the formula. D into 1 minus T plus E. With the tax. Without tax, just you need not write the tax. Generally, in all the questions, tax will be given. Okay, next. Levered, unlevered beta formula. Beta unlevered. Beta levered into beta levered into E by T into 1 minus T plus E. Plus E. Formula you have to remember, yeah, there is no choice for that. Okay, so tell me, what is the formula? Beta levered equal to beta unlevered into D into 1 minus T plus E by E. Beta levered equal to beta unlevered, beta unlevered equal to beta levered into E by D into 1 minus T plus E. Now the question arises, why this formula, how the questions will be tested? See here. Whenever a company, listen to my words, 5 minutes I will complete all the concept. Whenever a company is going for a IPO, whenever a company is going for IPO, or whenever a company is going for unrelated diversification, they don't have a beta. Reason is, beta is nothing but the correlation between market and the security. When correlation will exist between the market and security, if the security is in the market, if I am going for the listing for the first time, I don't have a previous correlation with the market, then how can I calculate the beta? Therefore, When you don't have a beta with the market, then compare it with a proxy firm. Proxy firm means a similar company will be there now, like you. That similar company's beta you can take, but you cannot take the beta directly. You have to make the tinkering works. 5 types of situation will come. How many? 5 types. A minute. Okay. See here. So the point is procedure to do the levered and unlevered beta calculations. Okay. First, see here. Situation 1. Situation 1. Proxy firm is unlevered. What is the situation 1? Proxy firm is unlevered. Okay. And own firm is unlevered. So listen carefully. If you can understand all these 4 situations, any kind of question you can solve. Please listen carefully. Proxy firm is unlevered. Means comparative company is unlevered. Means no debt, only equity. Own firm is also unlevered. Ours is also unlevered. We also don't have the debt. Both belongs to the same industry or not? Yes. You can take directly beta of unlevered of the proxy firm as the beta of unlevered of the own firm. Am I clear? So the first one, listen carefully. I will repeat. Proxy firm unlevered. Own firm unlevered. Proxy firm unlevered. Own firm unlevered. Both are unlevered companies. Then both are unlevered means both don't have the debt. Both don't have finance risk. Both have operating risk. When companies are belonging to the same category, operating risk will be obviously same. You will have one operating risk, I don't have another operating risk. Business model will have a risk. Okay. Automobile, any company in automobile will have a business risk. Business risk is common. What will change? Finance risk will change. Anyway, financing is not there. Your business risk and my business risk will be same. So beta of unlevered and beta of the own firm also will be same. There are 2 types of questions they can ask. Okay. Beta levered with proxy firm's capital structure. Convert. Beta unlevered is given. Consider directly. What does it mean? I will show you next. Second step. Second type of question. Situation 2. Proxy firm is levered. Means proxy firm is having debt in their capital structure. Own firm is unlevered. Means ours is not having a debt. What to do now? First, always remember one concept here. Literally mug up. Tomorrow exam is there. What knowledge you will gain now? First, try to directly understand the concept. Mug up the point. Listen. Question you are reading. Proxy firm has debt and equity. Your firm is not having any debt. First thing, always remember, unlevered beta is same for all the companies because unlevered means what? No debt. Risk is only business risk. Beta is a risk. Unlevered beta, risk of the business. Leverage risk is not there. Means finance risk is not there. Only what risk is there? Operating risk. Business risk is there. Business risk of any company belonging to the industry will be same. Keep in mind. First, proxy firm, levered or unlevered? Proxy firm is levered. Own firm, unlevered. Means what? We will take proxy firm's beta, convert into our beta. How to do? Levered beta means beta levered. Okay, this is given. Own firm, unlevered. That means first we should convert levered beta of the proxy firm. Listen, you should convert levered beta of the proxy firm into unlevered beta. Means unlevered beta equal to beta levered into E by T into 1 minus T plus E. Okay, tell me. We are calculating what? Beta unlevered. Beta unlevered of which company? Not one company. Entire industry will have one unlevered beta. Unlevered beta means there is no debt. Means no finance risk, finance risk, no finance risk. Which risk will be there? Business risk. Business risk of all the industries all the companies in the same industry will be same. So therefore, beta unlevered equal to beta levered of the proxy firm into E by D plus E. E means what? Proportion of equity, proportion of debt. Of which company? Proxy firm. They will give the proportion of equity debt in the question. So, using this formula, calculate beta unlevered. Once beta unlevered is calculated, that is the beta of all the companies in the same industry. Own firm is unlevered, na directly take. Unlever beta levered of proxy firm using proxy firm's capital structure. Consider the beta unlevered obtained as beta unlevered is same for all companies in the same industry. Third type of question you can ask. Proxy firm is unlevered, ours is levered. Means proxy firms is unlevered means whatever they give is the unlevered beta. Ours is levered. We have to calculate levered. Beta levered equal to beta unlevered into T into 1 minus T plus E by E. We should use our capital structures here because ours is levered. Using unlevered, we can calculate the levered beta. Next, proxy firm is levered and our own firm is levered. Both are levered. Competitor, we are taking levered beta 1.2. Ours is also their capital structure is 40 is to 60, debt 40, equity 60. Ours is also 40/60. Both are in same industry, business risk is same, both are having same capital structure, finance risk is also same. Directly take their levered beta in your calculation, 1.2, 1.2 over. No sir, 40/60 1.2, but our capital structure is not 40/60, ours is 30/70. What to do? First, what you have to do is take the levered beta of the proxy firm, convert the levered beta of proxy firm into unlevered. This is applicable to all the companies in the industry. Using your capital structure, again relever them. Then you will get the beta. Sir, we calculated beta in all the ways. Na? What is the use? CAPM la RF plus beta will be there. Na? In that you should put this beta. Okay? That's the concept. Now, it's time for you. Everyone in the class, answer. Understood the calculations up to here clearly or not? Everyone put the answer. Understood up to here? Next, the problems, just to do one or two problems, solve them and complete it. This is not the time to learn about the problem solving. Next model is arbitrage pricing theory. What is the concept? Arbitrage pricing theory. What is arbitrage pricing theory? Arbitrage pricing theory la two types of questions they can ask in exam. How many types? Two types. There can be two types of questions they can ask on arbitrage pricing theory. Just a minute, I'm getting one call. Just 1 minute, I will be back. Okay, let's continue. Arbitrage pricing theory la two types of questions can come. Type of question one. First type of question is they will ask you to calculate KE using APT model. What is APT model? See here. KE under APT is not RF plus beta into RM minus RF. Factor beta they will give. Different economic factors ki different betas and different risk premiums will be given. Formula. beta 1 lambda 1, beta 2 lambda 2, beta 3 lambda 3, plus so on up to beta n lambda n. The formula. Okay. Beta. Economic factor beta. GDP has a beta. Lambda 1. Risk premium for that. This will be actual return minus expected return. It's a formula. Okay. So just we have to multiply both of these and all the elements if you add, we will get the answer for the KE. Okay. But KE formula is not this. KE equal to lambda 0 plus beta 1 lambda 1, beta 2 lambda 2 and so on. Lambda 0 is risk free rate. Lambda 1 means risk premium. This is also risk premium too. For each factor there is a separate beta. For each factor we will ask a risk premium. In this model the unique feature is betas can also be negative or sometimes risk premiums can also be negative. So there can be negative beta, there can be negative risk premium. That's a unique feature of arbitrage pricing theory. Okay. Next one. Let us see one question as to how to do the arbitrage pricing theory. See the screen. See here. Like this, they will ask a question. First, calculation of KE. Calculation of KE. We calculated lambda 0 4.1 plus beta 1 lambda 1, beta 2 lambda 2, beta 3 lambda 3. If you observe the numbers clearly, here in the second case, beta 2 is positive, risk premium is negative. Third case, beta 2 is negative. Third case, la beta is negative, risk premium is also negative. So anything, positive negatives also will come in APT model. Finally, calculation. If you see this question, very popular question in the study material, small cap, small cap value, small cap growth, like that. 4 different cases will be there. See this question. It will be there in your study material as well, or whatever the book you follow, definitely this question will be there. Do this question without fail while going into exam. Nirmal, question name, the person name is Nirmal, is investing in some small cap growth, like that. One APT question will be there. Do this one question, done. So they are giving 3 situations. Small cap value, so small cap growth, lambda 0, beta 1 lambda 1, beta 2 lambda 2, beta 3 lambda 3. You will calculate. Small cap value, betas are changing but risk premium will be same. You will calculate 4. Okay, these are all individual calculations. 4 securities I am holding. One is small cap growth, small cap value, large cap growth, large cap value. 4 securities I am holding. 4 securities ki returns are calculated. In some proportion I invested, now this is the average return you have to calculate. That's all. But formula you have to remember. Properly apply and do the answer. You will get the final answer clearly. Up to here, everyone understood the point clearly? Next, another way of asking the question. There is one popular way of asking the questions in exam, that is the concept of short selling. Concept of short selling. Short selling is a famous way of asking the questions on APT. See here. This I will not take a risk. I will show you the question also. This question, if I tell, you will get a clarity. See here. This question you can expect in the coming exam also. Listen carefully. What they have done. Mr. X owns a portfolio with the following characters. Factor 1 sensitivity means beta. Beta 1. Beta 2. Security A beta 1.8. Security B beta 1 1.5. Security A factor 2 is 0.6. Factor 2 B is 1.2 is the beta. Next, expected return they have given. It is assumed that security returns are two-factor model means APT. Mr. X has 1 lakh to invest, sells short 50,000 of B and purchases 1,50,000 of A. What is the sensitivity of Mr. X's portfolio to the two factors? How to answer this? Listen. Mr. X is having 1 lakh. Short sold 50,000. When I short sell, money will come. but I have a liability to return back the share. Therefore, I am having cash liability, share liability, share liability. When share liability is there, beta will be there because share is there. So tell me, my portfolio wealth is how? 1 lakh rupees I invested in the security X. Okay, security A. Okay, see here. Mr. X has 1 lakh to invest, 1 lakh in hand. 50,000 I short sold B. Means I borrowed the shares and sold. 50,000 I got. Totally how much I have? 1 lakh 50. Full 1 lakh 50 I invested in A. What is the sensitivity of Mr. X's portfolio to the two factors? See here. What I have done? I have 1 lakh. I short sold 50,000. Totally 1 lakh 50. I invested in A. Means 1.5 proportion I invested. Beta is 0.8 for factor 1. Beta is 1.6 for factor 2. If you multiply, you got 0.45 and 0.3. This is the beta for two factors. Beta for two factors. For which security? A and B. Okay. This is the overall portfolio beta. Overall portfolio beta. Okay. So next, special case. This is a general case. Special case lo what he has done, let us see. See there, important. Mr. X borrows 1 lakh at risk-free rate. Borrowing money now. 1 lakh borrowing. Invest the amount he borrows along with the original amount of 1 lakh. How much he have? 1 lakh original amount is there. 1 lakh he borrowed in security A and B in the same proportion described in part 1. What is the sensitivity of the portfolio to the two factors? Read this point clearly before we go into the solution. That this is important question, don't take it easy. Okay. Mr. X borrows 1 lakh. At what rate? Risk-free rate. How much he have? 1 lakh of money already it is. 1 lakh borrowings also he made. Okay. And he invests the amount he borrows along with original amount of 1 lakh in security A and B in the same proportion described in part 1. What is the sensitivity? Important observation. See here. I have 1 lakh. I borrowed at risk-free rate of 1 lakh. Okay. Risk-free borrowings, cash borrowings made. Cash has a beta of 0. Okay. Next. I have done in the same proportion, he said. What does it mean? As described in part 1, same proportion. How much I have? 1 lakh. How much I borrowed? 1 lakh. How much is there in hand? 2 lakh. 2 lakh into 1.5, same proportion. 2 lakh into 1.5, 3 lakh. I invested 3 lakh in A. Okay, same proportion. He didn't say same proportion, same value, same proportion. How much I have? 1 lakh. How much I borrowed? 1 lakh. How much I totally have? 2 lakh. Same proportion of part 1 he has done. He didn't tell same proportion this answer will come. Investment is made in the same proportion in part 1. Part 1 how much proportion is put in A? 1.5. Invested or short sold? Invested. So 2 lakh into 1.5. 3 lakh I invested in A. If I have 2 lakh, how can I invest 3 lakhs in A? By short selling B worth 1 lakh. Calculate. Take a snap. If you have the books, very good. If you don't have, at least take a snap. Do the problem. This is not the time for repetition. I try to explain the overall essence of this concept. Everyone, please put me a message. Have you all understood or not? Everyone, have you all understood or not? Okay. Next. Next. Sharpe's single index model. So just I will give you summary of Sharpe model. Recent portfolio revision I kept at the last. Fastly I brushed through the concept of Sharpe single index model. If you want to listen to the problem, But concept I will explain. This is not a time to do the problems. Na? I will not waste your time. Just I will tell you the formula. Question given on sharp single index model. Yeah. Okay. Question came on sharp single index model. What to be done? First you have to calculate the beta. Calculate the beta. How to calculate? Either of the two formulas you use. Sigma xy minus n x bar y bar whole divided by sigma x square minus n x bar the whole square. This is way number 1. Okay, or you can use this formula. Mug up the formula first. Xy. X is always market. Listen to my words. X is always the market. Y is always the security. Don't interchange them. Answers will go wrong. X market. Y security. XY. Return of X market. Return of Y. 5 years information is given. Market return 10. Security return 20. 10 into 20, 200. Like that 5 years you calculate the total them. Sigma XY. N. Number of years given 5. X bar mean of X. Y bar mean of Y. Divided by X square ke sigma. Okay. This is not sigma X the whole square. X square calculate and sigma. N X bar the whole square. Apply, you will get the beta. Over. After getting the beta, what we have to do? We have to calculate the alpha. How to calculate the alpha? There is a formula. Sigma y equal to, take any of these two. Sigma y equal to n alpha plus beta sigma x. Sigma y equal to n alpha. N means 5 in our example. Na? Okay. Sigma y. Returns of y you will have. So you will put the number 10, some number. Okay. 5 into alpha we don't know. Beta we calculated. Na? So we got, say for example 0.5 into market total. Let us say it is 20. 10 equal to 5 alpha plus 10. 5 alpha plus 10. Or this is 15. 15 into 0.5 means 7.5. So 2.5 equal to 5 alpha. Alpha equal to some value will come. Okay. Why alpha is required? First, step 1, beta. What is the formula for beta? See here. What is the formula for beta? Just now I said, see this formula. Sigma xy minus n x bar y bar whole divided by sigma x square minus n x bar the whole square. First what we calculate? Beta. Once beta is calculated, next alpha. Put the number of beta in this particular equation. Sigma y equal to n alpha plus beta sigma x. Put the, what to say, all the information, put only alpha as a missing number. You will get the alpha answer. Once you get the alpha answer as well, this is the schedule. In the question, they will give actual returns. You have to calculate CML return. Okay, just a minute. Okay, so let's continue. So the point is, in the question, okay, whenever you do the question on that, they will give you a actual return. Actual return will be 12.62, 21.79 and 5.32. So these are the 3 actual returns. Next one, CML formula, characteristic market line equation. Beta RM plus alpha, beta into RM plus alpha. Beta, you calculated, step number 1. RM, market returns for each year, plus alpha, you calculated. For that alpha is required. You calculated CML return. Actual return of the security. This is RM, this is CML, this is actual return. What you got as CML, what you got as an actual, difference between both of them is the error. Difference between both of them is the error. Again I am telling, see here. Whenever sharp model came, he will ask you to calculate characteristic market line return. He will ask you to calculate what to say, risk of the particular security and divide it into systematic and unsystematic risk. What to do? First, you calculate the beta, step 1. Step 2, calculate the alpha, marks will be given. Step 3, CML written, beta RM plus alpha. Beta calculated in step 1, alpha calculated in step 2, RM, they will only give in the question. So this is RM. Using that you calculated CML. Compare it with the actual returns you already got in the question. Compare. Difference will be there. The difference we call error. Next, we calculated. What to do now? Then we have to calculate risk of a security. What is the formula for risk of a security? See here. Variance of security equal to beta square sigma m square sigma ei square. Beta square, you got the beta or not? Square. Sigma m, you will calculate the risk. Individual market risk will be given in the question. Square. Ei square, you have to calculate. How the sigma ei will be calculated? This is the errors or not? This is error 1, error 2, error 3. Total 0. E error minus error bar. 0 is this. Mean of the error is also how much? 0. 4.8 minus 0. 4.8 minus 2.13 minus 2.67. But if you square it, these numbers will not come. 4.8 square minus 2.13 square, 2.67 square. See here, I have done here. Market returns are given. Okay, market returns are given. We calculated. This is the sigma x square. This is the sigma y square. Error 3 years. E minus E bar, we calculated like this. Okay, we got the answer as 11.57. What is 11.57? We said that variance of security equal to beta square sigma m square sigma ei square. Okay, beta square, already we calculated beta, some number will come. Sigma m square, already this is the 45.5. Sigma ei square, you calculated. So the total variance of security is 12.6. Remember, whenever they ask a question, coefficient of determination will be there. COD equal to systematic risk by unsystematic risk. Means how the total risk is divided among both. Systematic risk 1.2. Unsystematic risk. Okay, sorry. Systematic risk by total risk. It's not unsystematic risk. I'm very sorry. Total risk means in the total risk of a security, how much portion is systematic, how much is unsystematic. 8% is systematic, remaining 92% is unsystematic in this particular question. Okay, whenever question comes in exam on sharp model, first individual security calculation, a simple concept. First beta, next alpha, next beta rm plus alpha. Difference between actual return and CML return is the error. After that, risk calculation formula, beta square sigma, beta square rm beta square variance of security equal to beta square sigma m square sigma e square. M square, M means return of the market, you can calculate using the standard deviation formula. Sigma EIA important, EI you calculated na, further calculated EI bar, it will be 0 obviously. EI minus EI bar, you will get one answer. Square it, total it. Okay, when you total it, what it will become? It will become EI minus EI bar the whole square, EI bar the whole square, divided by n. If you do, it will become sigma EI square. Again, don't do the root because we want variance directly. Don't do standard deviation. This is the formula. If in the exam portfolio is given, okay, what is given? Portfolio is given. That means same concept of sharp model. If it is given in the form of a portfolio, what to do? See here. First one, calculation of systematic risk. Calculation of systematic risk. Tell me, what is the formula? Variance of security equal to beta square sigma m square plus sigma ei square. Individual security, if you have to calculate for portfolio, beta of portfolio square. Do you know what is how to calculate beta of a portfolio? WL beta L, WM beta M, WN beta N, WK beta K, 4 securities. Total square. Sigma m square, sigma m will be given square. If already variance is given, directly multiply. This is a systematic risk portion. Okay, this is one security. We want portfolio. We want portfolio. Always remember, whenever portfolio error has to be calculated, old formula you have to use. Root will not be there because this is variance. WL square sigma EL square, WM square sigma EM square, WN square sigma EN square, WK square sigma EK square. So 2 into WL, W, all these will not come in unsystematic risk because unsystematic itself means there is no correlation. Correlation will be 0. Means EL and EM correlation will be 0. When you multiply, the total element will become 0. So this is not the time to learn about the concept. I'm just telling you, remember the concept. If they give portfolio risk calculation under Sharpe model, divide it into two parts, systematic, unsystematic. Beta square sigma m square, systematic risk part, sigma e p square, error of portfolio square, portfolio error. How the portfolio error has to be calculated? Normally, what is the portfolio risk with the two securities? Root of wx square sigma x square, wy square sigma y square plus 2 wx wy sigma x sigma y rxy. Correct? Anyway, variance the root will be going up. Wx square, Wx square, here Wx square. Sigma x square will not come, sigma ei square will come. That's what we are doing. Plus wy square, sigma ey square, wz square, sigma ez square, wa square, sigma ea square. 2 wx, all these will not come in Sharpe model. Reason I told you, na, unsystematic risk itself means there is no correlation with the market. Correlation is not there means correlation is 0. Even if you do this, rxy is 0, na, entire element will become 0. Therefore, just you will have this particular thing. We'll calculate systematic risk 543, unsystematic risk 17.56, total is 23.69. Do one or two problems in the study material without fail. Okay. All with the end of the chapter, portfolio theories and asset pricing, also called as portfolio management. Everyone in the class, please confirm, have you all understood up to here clearly? Everyone, have you all understood up to here clearly? So as fast as possible, I have completed three very important chapters: security analysis, security valuation, and portfolio theories. All the three chapters will be coming for a minimum of 25 to 30 marks in exam. Okay, security valuation, security analysis, and portfolio. Portfolio chapter la only one concept which is called as one concept, one problem. Sharpe model one problem, and Sharpe model optimum portfolio proportions concept is there. The two concepts just now I will record and I will upload it. Okay, because I also have to eat. I didn't eat anything, so I will have some food. I will upload that. 20 minutes I will complete both. One problem on Sharpe model, because my sixth sense is giving me a hint that this attempt Sharpe model will come. Therefore, one question on Sharpe single index model, one question on Sharpe optimum portfolio. Two questions I will do and I will upload just now. 20-25 minutes I will complete everything. Visit that, understand it, perfect. Done. Any question that comes in the portfolio chapter, you will be happening to do. Okay. Thank you very much. Do the remaining chapters also. Whatever I can do, what you cannot do while sitting individually. First three chapters: security analysis, security valuation, portfolio management. These are the three big areas we completed. Just revise with 5-6 problems only now. Take the RTP, do the questions, complete them. Once completed, next our target is you should do business valuation, mergers, acquisitions, mutual fund. Okay, all the videos are there in my YouTube channel. Whenever you find time, listen to that. Don't put it on 2x mode. Complete it very fast. Business valuation, mergers, acquisitions, mutual fund. Don't leave them. Prepare well. All the very best for your exams. Now I will upload two videos, 20 minutes video, one on portfolio theories, two problems. Sharpe optimum portfolio and Sharpe single index model, general portfolio problem. Second, business valuation, some small theory is there, that also I will upload. Okay, just listen for 40-45 minutes, complete it. Business valuation, mutual funds and mergers, do it properly. Videos are already there in the YouTube channel. Just press through the concepts and complete it very fast. Okay. Last attempt SFM. AFM SFM syllabus is same. Just listen to the SFM revision was given. At the time, mutual fund revision was also done. Mergers, acquisitions, mutual funds, and business valuation. Do that properly. Whenever you have a doubt, see the video and complete it. Okay. 3 important chapters I completed now, and I will upload one video. Just listen to that. It's a theory video. Okay? Thank you very much. All the very best for your examinations.